Hello, I'm Evan Kaufman, your VA loan educator, here to help go over our September highlights that we're looking forward to in the mortgage world. We're going to look at three major things. Number one, we're going to talk about the upcoming Federal Reserve September 16th, 17th discussion. Then we're going to look at what does firing a Fed governor do to rates, because that just happened. And then lastly, we're going to talk about how sports affect income qualification. Why? Because it's football season coming up. I do enjoy football, American football, for those of us always watching from around the world. Love American football. It's coming. I ran across an interesting little article on just how professional athletes qualify for loans. Now, let's go back to number one. The Fed meeting coming up in September 16th, 17th. Big meeting that's coming around the corner. We've had a lot of mixed economic news coming in for inflation and jobs data, to the point where everyone right now is anticipating that mid-September, 16th, 17th September, there will be an announcement that the Fed intends on cutting back their Fed funds interest rate. Now, keep in mind, ping right away if you're like, Evan, that means rates are going to go down here in the near future. Maybe. They've already pulled back because we have another couple good videos on it. The Fed cutting back the Federal Reserve fund rate does not necessarily mean mortgage rates directly correlate and go down. The Fed will adjust their Fed funds rate. That is the rate technically that banks can borrow from the Federal Reserve. That will inadvertently affect the 10-year Treasury yield, which that affects mortgage rates. They kind of go together, and they're not always perfect or synced up one another. Really, though, mortgage rates travel closely with the 10-year Treasury yield, which oftentimes will try to lead the Fed fund rate moves. So we've already seen some decrease in mortgage rates over just the past month. You look back at my August update, we were talking about that coming. That has occurred now, and we've seen some pullback in mortgage rates. However, that's assuming that the Fed will actually make cuts in September. This is one of those weird scenarios where on September 16th, 17th, if the Fed starts indicating at all that they plan on keeping rates the same, you'll actually see mortgage rates go up most likely. Or if they cut them but not hard enough, or they don't speak right, rates could still go up. Now, if they happen to cut them further than expected, we could see rates come down even further. But again, from the basic talk I just gave there, Fed fund rates don't directly affect mortgage rates. Mortgage rates typically try to lead what actually happens with the Fed fund rates. So it'll be very interesting coming up here over the next 2 weeks. Typically, what do we see leading up to that time? We see a lot of volatility. That's where if you have a good deal right now that you're hearing on your mortgage rates, it's worthwhile to lock that one in, especially if you're closing on a home here by mid-end of September to make sure it gets done. And good news is if rates come down over the long term and you happen to have really any loan, but VA loans specifically, because that's what we work with often, you can always do that streamlined or finance down the road if rates get drastically better over the next 6 to 9 months. But now let's look at number two, which is tied to that Fed meeting in September 16th, 17th, and that's what happens when a Fed governor is fired. And that's because ultimately we did have President Trump come out and fire one of the Fed governors, which is pretty wild. Lisa Cook, Fed governor, Trump came out and said, hey, we are going to let her go. Now there's of course a whole court proceeding and everything because she doesn't want to go. There's also obviously backstory to that. Some people like to say, hey, there might have been some deep fish in there to make sure that we could try to get her removed from the executive branch level. So there's going to be an open-ended argument and discussion there, and that might not be solved still for months to come. However, we believe the goal ultimately for that was if we can remove one Fed governor, replace it with another that might be more pro-cutting federal funds rates, which could inadvertently lead to mortgage rates, that might be the end goal for administration. But point is, firing a Fed governor, how does that affect mortgage rates? Touch on this a little bit before in previous ones when there was discussion of trying to let Fed Chairman Powell go. What happens is the same thing as with Fed Chairman Powell. Ultimately, we could see more volatility in the market. So with Lisa Cook looking like she's going to be on the outs because of the firing, we could see more volatility in mortgage rates, and that's exactly what we saw with that announcement. Some people would assume, oh, that means rates could go down because we're getting the right person in. Remember, investors, folks who are buying that 10-year Treasury bond and stuff, are educated to a good point, and they're skeptical of, hey, by removing Fed governors or Fed chairmen, that can create more uncertainty because we don't know if the Federal Reserve is going to be as independent from political entities as it was before. One thing that I believe we as Americans really take advantage of is that the Federal Reserve is, it is tried to be as separate from the typical governing power as possible, meaning that Democrat, Republican in office and controlling the Senate, House, or the executive branch as president has had minimal impact on what the Fed decides. And there's a Federal Reserve Act to try to make sure that their schism was there, that there was a split between the two. Because ultimately, we can see from other examples around the world, if political parties can have control over central banks, you typically see high inflation, because ultimately it's in their interest to make sure that rates are always low, which sounds great in theory, but it can cause rampant inflation, which can be as dangerous or even more dangerous than making sure that everyone has access to low interest rates overall. So it's a very delicate balance that I think we take for granted. And the thing is, if all of a sudden the executive branch is changing out governors or chairmen, that shows some uncertainty. So ultimately, that has meant sometimes to see mortgage rates actually spike up when there's news on these issues. So it's a really interesting deal, but that's what we're starting to see right now is a lot of uncertainty because of this recent attempt to fire Fed Governor Cook. We'll see where that all lands, but I do think over the month of September, we're going to see that start to shake out as that works itself through the court system. So there was a lot of exciting fun to look into September saying, hey, there's a big meeting from the Fed and there's this firing of a Fed governor going on, which is going to add some other weird nuances of stuff. By the end of September, we're going to know quite a bit more. We're going to know what happened in that meeting. We'll probably have some idea of what direction that whole firing is going, where it's going, if it's going to go further in the courts or not. We're going to have a decent indication of that. So that's what's going to come up over the next month in fun mortgage news. And interesting news to stuff, football season is now around the corner. First kickoffs for football were just last week, which is really good and exciting. Myself went to a game. It was a lot of fun. One thing that came across my desk for things was how professional athletes can get mortgages. I would love to say that I've done the mortgage of a lot of pro athletes, but we haven't. We obviously work a lot for active duty military, so a little bit different subset of working for people. But one fun random nuance that I came across was, did you know that some professional athletes, especially in other countries where we don't necessarily have fixed 30-year mortgages that people can get, like in the United States, professional athletes can often be judged on their age because of their ability to continue their earnings. For example, a lot of soccer players in other countries, sometimes banks, this is me reading some random article from a finance company saying, hey, that sometimes they're evaluated up to like age 35. So if all of a sudden age 35 and beyond, they assume they might have no or very minimal income because that's kind of the age that you start to phase out for your athletic years as a soccer player. That was interesting. There's some sports, though, that can work longer than others. But the interesting thing is, we're in America again. Sometimes we take for granted that conventional 30-year mortgage, meaning that we got to underwrite and not include some of those things so you can get a mortgage a little bit easier. But if it's not that here in America or other countries, if you're a professional athlete, you'd be criticized for that age. So when you hear guys getting those nice multi-million-dollar contracts, oddly, they might not be able to get the really nice homes to go with it sometimes because banks or lenders might be criticizing their age and their ability to continue to perform into the future. Odd, random fun fact for its sake. So if you got that good, steady job for stuff and sometimes you're wishing you're that pro athlete, hey, you might have the better chance at getting a better mortgage rate and getting a mortgage easier than some of those pro athletes. Take that for what it's worth. My name is Evan Kaufman. Again, those are three major things that one interesting thing I should say, and two major things that we see coming up in the month of September. Please feel free to reach out with any questions. Hope all is well. Take care. Bye-bye.